Value Investor Daniel here. So if you've seen any of my recent videos, you would know that I've been kind of bearish recently. The S&P 500 and the Nasdaq especially are very high right now. And in my past few videos, I have said specifically that I have not been purchasing stocks recently, but that has changed. Today I'm going to share with you a stock that I think is very undervalued. This is a stock that I physically just bought a couple days ago. I'm going to explain my thought process behind investing in this stock, which I think is 10 times more important than knowing the stock's name, because I'm gonna teach you many things that you don't know about this stock. Just make sure to destroy the like button so the YouTube algorithm is in favor of me. Did you hit the like button yet? Did you make it blue? Okay, let's get right into the video. So the stock I'm talking about today is Foot Locker, and here's what you need to know about it. Obviously, Foot Locker is an athletic shoe retailer, selling probably some of the most overpriced shoes on this planet. And here's what got me thinking about this stock. About a week ago, I went to the mall and all the shoe retailers were pretty much empty, except Foot Locker. Foot Locker was at full capacity. The line outside Foot Locker was also at full capacity. I was like,
oh my gosh, I can't believe so many people are willing to pay so much money for shoes during these times.
Then I decided to buy their stock and profit off of the people who are paying a lot of money for their shoes. Obviously, that's not the only reason I bought that stock, but it got me thinking about it. The first thing that you need to know about this stock is that 70% of their sales come from Nike products. This looks like a huge red flag. Whenever you run a business, right? You want to diversify your revenue streams as you would diversify your stock portfolio. You would not want to be too reliant on one account or on one stock. And Foot Locker probably has the least diversified revenue stream out of any company. This is very dangerous because if something happens to the relationship between Nike and Foot Locker, it's game over. However, Nike is also heavily reliant on Foot Locker. Foot Locker sells over $5 billion in Nike products every year. So if the relationship goes bad between Nike and Foot Locker, Nike is going to be losing out on billions of dollars of sales every year. Foot Locker is a tool for Nike to grow. So the chances of anything going wrong with their relationship is quite small, because their relationship is mutually beneficial for both companies. So there's very little risk with Foot Locker mainly selling Nike products. Also, if a sneakerhead goes to Foot Locker today, they're gonna notice something very unique about Foot Locker. Everyday investors like you and I are not going to notice this unique characteristic about Foot Locker, but sneakerheads are going to pick up on this characteristic. And this characteristic is that Nike currently offers Foot Locker exclusive products to sell in their stores. The people who are mainly buying these exclusive products are the sneakerheads. As these sneakerheads become a regular Foot Locker customer, the sneakerheads are going to go tell their sneakerhead friends,
hey, come to Foot Locker, they have so many cool shoes and it's such a nice place to shop for shoes.
Then they're gonna go to Foot Locker and start buying shoes from Foot Locker. So the company essentially has a low-key smart word-of-mouth marketing strategy in place that's gonna facilitate their growth for the long term. In fact, in a book called This Is Marketing, Seth Godin describes the importance of appealing to the smallest viable audience, the people who are your best customers. According to Seth Godin, appealing to the smallest viable audience, or sneakerheads for Foot Locker, will help a company grow over the long term. If a company like Foot Locker can create an amazing experience for sneakerheads who currently shop at Foot Locker, they will tell people who they know who are also likely to be sneakerheads, hey, come shop at Foot Locker, which is going to help them get a ton of long-term customers. And Foot Locker is doing exactly that because they are offering exclusive products that sneakerheads love and that sneakerheads cannot find anywhere else. And as I said before, there's very little risk of Foot Locker stopping to offer these exclusive products because they're in a mutually beneficial agreement with Nike. But obviously though, most of the company's sales come from retail, and it's no surprise that retail is absolutely getting obliterated right now. So the question simply is, can Foot Locker make it through this crisis? Will they survive and become profitable afterwards? Well, first off, they have $900 million in cash in the bank, which is plenty of cash for them, especially for a company that has a $3 billion market capitalization. They could pay off all of their long-term debt off if they wanted to right now of $100 million. In fact, they're expected to be profitable this quarter, so there's going to be a positive amount of cash coming into the business this quarter. which means that the probability of them actually going bankrupt or anything like that is very slim to none, because they're still gonna make money this year. So it's just gonna be very hard for this company to actually go bankrupt, especially since they have so much cash on hand. But why buy this stock at $27? Why is $27 a good price to buy this stock, in my opinion? You have to keep in mind that it's still up 50% from its lows back in March. Well, this year they're expected to make about 60 cents in EPS this year, which is essentially nothing for the company. I'm just happy that they're actually going to be profitable this year, and that alone is a good sign. But next year is where it actually gets interesting. Next year they're expected to have an EPS a little over $3 per share, which would put them at a forward PE ratio under 10. Having Foot Locker trade at a forward PE ratio under 10 indicates that this company is super undervalued. They're essentially a retailer for Nike, a very big brand that usually trades at a much higher PE ratio. They're essentially a retailer for them, and they're trading at such a low forward PE ratio, which indicates that the stock is undervalued. But other than that, I hope you like this video. Make sure to drop a like and subscribe down below. It really helps out a lot.